My boss Bhuvan was happy with the video last week thanks to all of you who took the time to comment. I still have a job. Jokes aside, thank you for tuning in. Welcome to Who Said What. I am Krishna, and in this show, I dive into interesting comments made by notable figures from across the world, whether it's in finance or the broader business world, and dig into the stories behind them. By the way, if you come across any interesting comment you think I should cover, feel free to share it with us. You can comment it down below or tag us on Twitter. Today, I've got 5 very interesting comments for you. In the first story, I'll talk about whether FIIs believe in India or not. Recently, Swanand Kelkar, former MD at Morgan Stanley and now with Breakout Capital, came on ET Now. The conversation eventually veered into one of the most debated topics right now, which is why are foreign institutional investors or FIIs dumping Indian equities? See, whenever FII outflows make headlines, the usual chorus of assumptions kick in. I've heard that people mostly say that they don't believe in the India growth story anymore or Indian stocks are too expensive. Kelkar doesn't agree with this narrative. According to him, these assumptions miss the bigger picture. See, the truth is, global capital flows are driven by a range of external factors. Currency risks, US rate hikes, and India's position within global financial benchmarks. Now, let me break this down and dive into the real reasons behind the outflows, according to Kelkar. First, India isn't a priority for global investors. Kelkar pointed out how global fund managers allocate their money.
Out of the 100 rupees which is there in the total financial market, 65% is in US.
That's right. So if I am a global asset allocator, what does that mean? If I put money into multiple equity markets across the globe, the index against which I am measured, the weight is 65 to 70% US. Emerging markets all put together is 10%.
Here's what he means. See, large institutional investors, think pension funds, sovereign wealth funds and mutual funds, allocate capital based on indices like the MSCI World Index. This index is heavily skewed towards US markets with a 65 to 75% weight dominated by tech giants like Apple, Microsoft and Amazon. India, on the other hand, has a mere 2% weight in the index. If you look at this graph, India isn't even mentioned. India's market isn't big enough to move the needle for global investors. See, when macro shifts like rising US interest rates hit, fund managers often pull out of smaller allocations like India first, not due to weak fundamentals but to manage risk and focus on larger markets. For many FIIs, it's more about their global strategy than anything specific to do with India. Second, currency depreciation is a major concern. Kelkar emphasized another critical factor.
One is that you have to contend with a rupee depreciation which is on trend 2-3%. That is not specific to India, that is true for most emerging markets. And plus, at the least, you are going to pay 12.5% of capital gains. Right? So, if let's say you are US and you are India, if you add up the currency and the tax impact, on day one, you have a handicap of 400 to 500 basis points.
This is crucial for foreign investors. See, when they invest in Indian stocks, they do so by converting US dollars into Indian rupee. But over time, the rupee tends to depreciate against the dollar by 2 to 3% annually on average. This depreciation eats into the returns when investors convert their profits back to dollars. Here's a simple breakdown. An investor earns 12% in rupee denominated returns from Indian stocks. The rupee weakens by 3% over the same period. The real return in dollar terms drops to around 8.6%. Factor in India's 10% LTCG or long-term capital gains tax and the effective return drops even further. Compare that to US Treasury bonds which currently offer 4.5 to 5% risk-free returns. For many investors, especially those looking for stability, India's returns no longer justify this currency risk. Third, emerging markets are facing similar outflows. To add further context, I came across a post from Vinay Paharia which included a chart from Axis Capital Research. This chart tracks rolling 12-month FII flows across emerging markets like Brazil, Korea, Taiwan and India. Now what does it show? Many emerging markets have seen significant FII outflows in recent months, not just India. This supports Kelkar's point that FII behavior is often influenced by global portfolio strategies, not country-specific factors. When investors pull out of one EM market, they often do so across the entire asset class. Fourth, India's tax policy adds to the disadvantage. He tweeted this: No country, as in zero countries, charges capital gains taxes to foreign investors. This includes the US, UK, Japan, etc. India cannot be unique. See, here's the problem. In most developed markets, foreign investors are exempt from capital gains tax. In India, FIIs must pay 10% LTCG tax on equities held for over a year and 15% on short-term gains. For FIIs, this reduces net returns and makes India less attractive compared to markets with more favorable tax regimes. Arora has even suggested that scraping the tax could even boost capital inflows and improve market sentiment. Fifth, Indian markets aren't delivering enough returns. Kelkar pointed out a simple but important fact.
If you are only going to produce 10-12%, might as well consider US treasuries as well, which are yielding 4.5-5%.
Back when Indian markets were delivering 25 to 30% returns, FIIs weren't as concerned about currency risk or taxes. But now that the returns have moderated to 10 to 12%, those extra costs are harder to ignore. Investors seeking higher returns might look to other emerging markets or even risk-free US assets instead, as I mentioned earlier. This was all that he mentioned about FIIs. I really enjoyed diving into this topic because some of my understanding around this is more clear now. Like I said in one of my previous episodes, I am new to the markets and this show is a selfish way for me to learn more about the markets. Now for the second topic, I'll touch upon small caps. Said this in an interview with LiveMint. I believe this is the time to even stop small and mid-cap SIPs because they are so overvalued right now. It's a wake-up call from one of India's most respected fund managers, warning investors not to get trapped by the hype. Small cap and mid-cap stocks have become dangerously expensive, and Naren sees trouble ahead. He further says, it is a sitter that in the medium term, small and mid-cap SIPs are unlikely to deliver returns. If you invest at these levels, you are basically averaging out at very high valuations. So why is Naren, known for his contrarian views, hitting the brakes? The problem lies in the market's frothy momentum. He points out that small and mid-cap valuations have absurd levels. A median PE of 43 of these stocks has stretched far beyond sustainable limits. Worse, the PAT contributions from these companies don't justify their skyrocketing market caps. He says, if we looked at the entire PAT contribution versus the market cap, and again, it shows that the market cap contribution is much higher than the PAT contribution. Naren explained underlying how the fundamentals don't back up the prices investors are paying. See, this isn't just a theory. He has seen this pattern before. Between 2017 to 18, small and mid caps rallied to similarly unsustainable levels. AMCs like ICICI Prudential, DSP and SBI Mutual Fund took drastic step of capping inflows into their small cap funds. Their reasoning was clear. When a market segment overheats, large inflows can force fund managers to invest at inflated prices, ultimately hurting both new and existing investors. After the rally broke, small cap funds endured years of underperformance. Naren believes the current situation is deja vu. Momentum has started to weaken, he said, referring to the technical indicators that track market trends. Both small and mid caps have broken completely and decisively on these measures, signaling a potential downturn. He is also worried about leverage. As investors borrow more to chase rising stocks, the market becomes even more fragile. When you have so much leverage, you have a situation where at any point in time you can have a problem. Naren warned. He isn't against SIPs altogether. He just emphasizes that the timing and valuations matter. Everyone says SIP sahi hai, but if you do it in the wrong product, you are headed for trouble. His current focus is on large cap and hybrid funds, which he believes offers better returns given India's stable macroeconomic outlook. This is maybe even the time to do aggressive SIPs in large cap and flexi cap funds. He noted, highlighting how foreign institutional selling has created attractive valuations in this segment. See, the lesson here is simple. SIPs work best when you invest in undervalued markets. Naren has a reputation for cutting through market noise, and his advice is now crystal clear. Small and mid-cap investors need to stay cautious or prepare for a long, bumpy ride ahead. For the third story, I saw a tweet from Nitin Pai, co-founder of Takshashila Institution and a leading voice on international relations. He said this: the US is about to find out that other states are sovereign too, and they too can act in self-defeating ways. Now, if you are not living under the rock, you'll know he's referring to Trump's tariffs. Pranav from the team has written about this topic twice in the past week. As for me, well, before this, the only tariff I knew was the Hindi word for compliment. Thanks to Pranav and a bunch of other people I have read to understand more about this, I think I have some sense of what's going on. Let me tell you everything I learned this week about the tariffs. So the basic question, what is a tariff? Think of tariff as a cover charge at a club. The government charges the fee when goods enter the country, supposedly to protect local businesses. But if the cover gets too expensive, everyone suffers. The drinks or the food inside becomes unaffordably expensive. Now it's not just a tax you pay once. In today's globalized economy, products cross borders multiple times. In the first 2 weeks of his presidency, Trump placed a 25% tariff on imports from Mexico and Canada, then delayed it by 30 days the next day. I mean, classic Trump, right? He also imposed an additional 10% tariff on all Chinese goods. Here's where things get serious. Before Trump, the average tariff on US imports was just 2.4%, and now it's 10.5%. That's one of the largest tariff hikes in US history. For context, economist Kyle Hendley and Andrew Greenland pointed out that the last time tariffs spiked this dramatically was during the Great Depression with the infamous Smoot-Hawley tariffs. Those tariffs were so disastrous it took 50 years to undo their effects, and that was in a far less globalized world. Imagine the potential fallout today. They also contributed to the Great Depression of the 1930s. Just a fun fact, the Dow Jones Index fell 89% during the Great Depression. See, Trump's core argument is that tariffs will bring back American manufacturing jobs by forcing other countries to play fair. It's a compelling narrative. Here's one tweet I saw on this. The US is 4% of the world's population but roughly 30% of global consumption. Tariffs works for us because we have the most desirable consumer market on earth and can force concessions in a way no other country can. This might seem like a winning strategy. In fact, it has worked in isolated cases. When Colombia refused to accept deportees from US, Trump threatened massive tariffs. Within hours, Colombia backed down. But here's the thing. Modern trade isn't a simple transaction. You can't just bully countries without serious repercussions. Take cars for example. Cesar Hidalgo, the founder of OEC, explains how a single car part might cross the US-Mexico border multiple times during production. Each crossing adds another tariff. A $100 engine part can rack up $56 in tariffs by the time it's done. So much for the headline 10% tariff. The same goes for other industries. US oil refineries are built to process thick, heavy Canadian crude oil. They can't just switch to lighter American crude. Or take construction. Most industrial grade glass used in US is imported from Mexico. These tariffs don't just raise prices, they disrupt entire ecosystems. Kyla Scanlon, who's probably one of the better content creators on economics and finance, points out another reason tariffs often fail. Tariffs are marketed as a way to protect American industry, but in reality, they are a tax on American consumers, an affront to our closest allies, and a gamble that the global financial system won't retaliate. See, our point is you can't just slap a tariff on complex supply chain and expect everything to magically fix itself. Global trade is like a machine with countless moving parts, and messing with one part can break others. Of course, other countries aren't taking this lying down. China retaliated with 15% tariffs on US energy imports and 10% on American agriculture equipment. They've also restricted exports of critical minerals used in defense industries, plus an investigation into Google. But the biggest retaliation is coming from America's closest allies. Canada imposed a 25% tariff on 30 billion Canadian dollar worth of US goods. British Columbia even banned alcohol imports from red states that voted for Trump. That's some next level pettiness. Former Treasury Secretary Lawrence Summers warns of the long-term impact. Jobs in the industrial heartland will be lost as American producers can't compete due to higher input cost. Canada and Mexico will lose trust in us. Immigration and drug risks will increase. There's also a broader question here. Does America really want those lost manufacturing jobs? Economist Joseph Steinberg argues that trade with China didn't just destroy jobs, it created better ones. He says, the US didn't subsidize China by running a trade deficit. By selling the US cheap goods, China actually subsidized the development of the US tech sector. So in other words, the US may have traded low-paying textile jobs for higher-paying tech jobs, but Trump's tariff could reverse that progress. The scariest part of all this isn't the immediate cost, it's the uncertainty. Companies can handle high tariffs if the rules are clear, but constantly changing policy, that's a nightmare. Imagine trying to start a business when you have no idea what your cost will be 6 months from now. Research shows that this kind of policy uncertainty freezes investments. Businesses stop expanding because they can't plan ahead. This is precisely what the post-World War II economic order was designed to prevent. Between 1950 and 2023, global trade grew by 4,400%, largely because trade agreements reduced this unpredictability. The most profound implication of Trump's tariff isn't economic, it's geopolitical. Marco Rubio, Trump's Secretary of State, recently acknowledged this shift. It's not normal for the world to have a unipolar power. That was an anomaly. Eventually, you are going to reach back to a point where you had a multipolar world. And we are seeing this play out. Of the world's 10 fastest growing trade corridors, only 2 now involve the US. China is stepping up as a rule maker in global trade, filling the leadership vacuum America is leaving behind. All this brings us back to Nitin Pai's observation. Sovereign states can act in self-defeating ways. America's tariffs might give it short-term wins, but the long-term cost could be its role as the architect of the global economic system. Kyla Scanlon wrote this: Trump is testing whether chaos itself can be monetized, but history suggests this is a dangerous game. The last time America embraced protectionism, it took 50 years to repair the damage. This time, the stakes are even higher. The question isn't whether America can force its will on others through tariffs. It's whether it's sacrificing something far more valuable in the process. Maybe its reputation, for instance. By the way, Kashish, one interesting guy from the team, sent this on our group. It's funny how the flag bearer of capitalism, that is the US, has become so anal about protectionism and tariffs, while the communist China can only fight its own domestic problems as they sell more and more goods abroad.
Well, well, well. How the turntables.
Now, since we are on the topic of tariffs, there is something else I came across that's India specific. We are signaling that India is not a tariff king. This was declared by our finance secretary in a recent interview, emphasizing that India is open for business. The comment came alongside import duty cuts on certain goods in the latest budget. But while the government insists that India's tariffs are globally competitive, many businesses might roll their eye at that statement. This tension between tariffs and policy predictability is a recurring theme in India's trade story. See, India has come a long way since pre-independence, but there is a long way to go. Let me give you some context on how things were before long back. See, when India gained independence in 1947, the trauma of the colonial rule was still fresh. For over a century, British policies had gutted India's economy. See, back in 1750, India accounted for roughly 25% of global textile production, but by 1947, it had become a supplier of raw materials to the British Empire. This shaped Jawaharlal Nehru's deep mistrust of international trade. Nehru believed that allowing unfettered foreign investment would reduce India to a neo-colony. His government responded with a policy of import substitution, aiming to build local industries by blocking foreign goods. Here enters the license Raj. Starting in 1950s, the government imposed an elaborate web of regulations. Businesses needed licenses for nearly everything. Expanding production, importing raw materials or machinery, even deciding how much to produce. Tariffs on imports were astronomically high, some exceeding 355%, while entire categories of consumer goods were banned outright. You know, if you wanted a foreign car, you would have a tough luck. For decades, this system kept domestic industries alive, but very barely so. Companies had no competition and therefore no incentive to improve. Bureaucratic red tape strangled innovation. By the late 1980s, India was stuck in economic stagnation with rising deficits and dwindling foreign exchange reserves. By 1991, the situation was untenable. India had less than 3 weeks worth of foreign currency reserves and faced a full-blown balance of payments crisis. Think of BOP crisis like running out of foreign money. Just like you need US dollars to buy stuff from America, countries need foreign currencies, which is usually the US dollar, to buy things from other countries. When a country runs out of these foreign currencies, it's like being broke. They can't buy important stuff from other countries or pay back their international loans. That's what a balance of payment crisis is. Desperate for an IMF bailout, India was forced to dismantle the license Raj and liberalize its economy. See, the reforms were sweeping. Import licensing was abolished for most goods. Tariffs were drastically reduced. By 2008, the peak tariff rate had fallen to 10% from 355% in 1990. Foreign investment was welcomed, leading companies like Pepsi, General Motors and Microsoft to establish operations in India. These reforms sparked an economic boom. India's GDP grew rapidly. Industries like IT and automotive flourished. For a while, it seemed like India had left its protectionist instincts behind. But then something changed. Since 2014, India has quietly increased tariffs again. Under the Make in India initiative, the government wants to strengthen domestic manufacturing and reduce reliance on imports. While the overall average tariff rate has risen modestly from 13% to 14.3%, the increase is more dramatic in key sectors. Today, imported cars face tariffs of 125%, motorcycles 100%, and toys 70%, and textiles 25%. Even worse, the share of tariff lines with rates above 15% has more than doubled since 2010. The government argues that these measures protect local industries and create jobs, but critics warn that they discourage foreign investment. The recent budget's duty cuts on vehicles may signal a softening stance, but businesses remain skeptical. After years of steadily rising tariffs, a few reductions are unlikely to erase concerns about policy unpredictability. This brings me to the Volkswagen case that I wrote about in the last week's daily brief. See, Volkswagen tax dispute illustrates a deeper issue than tariffs alone: regulatory unpredictability. See, Volkswagen has been accused of dodging duties by importing car parts separately instead of bringing in completely knocked down kits or CKDs, which are taxed at 30 to 35%. Volkswagen insists that it followed the rules and that Indian authorities approved that strategy in 2011. But over a decade later, the government has changed its stance, issuing a $1.4 billion tax demand. Volkswagen frustration is understandable. The company described the tax demand as a body blow to India's much-touted ease of doing business initiative, warning that such surprises make global companies rethink their investments. In plain terms, Volkswagen is saying this: this kind of surprise makes us and other global companies think twice about doing business in India. Imagine running a business where you follow the rules only to have them returned retroactively. See, this isn't an isolated case. The Vodafone and the Kane Vedanta disputes followed a similar pattern. Vodafone won a Supreme Court case against a multi-billion-dollar tax demand only for the government to change the tax laws retroactively to make Vodafone liable. Kane's assets were even seized before the dispute was finally settled. India's journey from colonial exploitation to protectionist policies and then economic liberalization has been long and complex. Today, the challenge is twofold. First, creating a competitive tariff environment that encourages trade. Second, building trust through policy predictability and stability. For the last story, see, it's been a while since I spoke about my favorite topic, quick commerce. You see, Zepto's been on a mission lately to bring in more domestic money. Their previous funding round with Motilal Oswal Private Equity was already a step in this direction. Now, they have reportedly tapped domestic mutual funds for $300 million secondary share sale, aiming to dilute the foreign investor stakes and get the ownership structure more in line with the Indian laws. I came across Deepak Shenoy's tweet on this. Zepto needs to bring foreign ownership below 50%, so they classify as an Indian company for not getting dinged on controlling inventory. See, here's the context for this. If a company is foreign controlled in India, which Zepto currently is, it can't legally own inventory under current FDI rules for e-commerce. So if Zepto doesn't fix this, it risks falling a fool of the law. A nightmare scenario when your entire quick commerce model depends on tight control over inventory and logistics. Piyush Goyal has previously hammered home the point that e-commerce firms must follow local laws to the letter, particularly when it comes to ownership structures and inventory control. Platforms like Amazon and Flipkart have spent years navigating these waters, setting up complex structures with third-party sellers and local partnerships to stay compliant. Zepto, however, is trying a different route, becoming more Indian by ownership to avoid these legal battles altogether. Deepak Shenoy also made another important observation. Mutual funds can't really buy pre-IPO unless the IPO is immediately happening. This might have to be at IPO. This hints at timing challenge for Zepto. They're quoting domestic mutual funds for a share sale just ahead of their DRHP filing, but mutual funds typically prefer clearer IPO timelines to justify such investments. But all in all, it will be interesting to see how this evolves. That's it for this episode. If you have any feedback for me, please let me know in the comments below. Start होने देना, कहाँ जा रहा है? Words नहीं आ रहे मेरे को. Sorry. कशिश का नाम कैसे wrong ले रहा हूँ? When you have so much leverage, ये बहुत comfortable है. रजाई ला दो बस अब, यहाँ पे ही सो जाऊँगा.